All right, today we're jumping into something big. MicroStrategy's wild, all-in bet on Bitcoin. I mean, this is a playbook that has everyone in finance talking, and for good reason.
Let's start with a number. $72 million. Just let that sink in for a second. That's how much in assets MicroStrategy stacked up per day. Not per month, not per year, every single day for 2 years straight. It's just a mind-boggling figure.
And this quote really nails the paradox at the heart of it all, doesn't it? This insane level of asset growth with zero operational overhead but meh cash flows. It's this exact dynamic that has critics screaming and supporters cheering. So, okay, let's really get into what's going on here. Okay, so here's how we're going to break it all down. First, we'll look at their locked-in strategy. Then we'll see how traditional finance is trying to make sense of it. After that, we've got to talk about the debt. That's a big one. Then we'll get into the core philosophy of capital versus currency. And finally, we'll unpack their new big idea called stretch. Sound good? Let's do it.
Okay, first things first. To even begin to understand what MicroStrategy is doing, you have to get into their heads. This isn't just some clever investment. No, this is a full-blown, all-in, total conviction play.
The sources we looked at describe a team and a community that are just completely locked in. Like, there's no plan B here. And get this, the goal they're shooting for isn't just to make a bunch of money. The goal is to become the single most powerful and valuable company in the world, all by leveraging Bitcoin.
So, you've got this incredible conviction, right? But it's on a collision course with the old way of doing things. And that brings us to the big clash. How a company like this gets graded by traditional financial ratings agencies like S&P.
So, S&P Global looked at them and gave them a B rating. And they laid out a pretty standard roadmap for an upgrade. They basically said, look, you need to hold enough cash to cover payments for a year, you got to ease up on all that convertible debt, and you need to show us you can still tap the markets for capital. Sounds reasonable, right?
Well, here's where it gets really interesting. The response from supporters is basically, you're using the wrong tools. The quote says it all. This is S&P using a ruler to measure a gravity well. It's such a great metaphor, right? The idea is that the old metrics just can't capture what's happening here, and that the rating will have to play catch-up to reality, not the other way around.
And that leads us right to the biggest, scariest question that all the critics bring up: the debt. I mean, we're talking about a mountain of it, all taken on to buy Bitcoin. So the question is, are they setting themselves up for a total disaster, a forced sale if things go south?
Well, the source material pushes back hard on that fear by just laying out the numbers. And let's look at this together. Their yearly interest payments, about $800 million. But look at their cash on hand, almost $1.5 billion. That's a year and a half of cushion right there. And the real kicker? Look at the bottom. Their first big chunk of debt isn't even due until 2027. So the panic button is still pretty far away.
You know, it's funny. Our source draws this incredible parallel. Look at the criticism thrown at Amazon back in 2002. They don't make money. The internet is a fad. Now look at what people are saying about MicroStrategy today. It's almost the same script, isn't it? It just goes to show you, radical new ideas always sound crazy at first.
Okay, so this next part is maybe the most important piece of the whole puzzle. If you want to understand why they're doing any of this, you have to get this one core idea. It's a philosophy that drives everything, and it all comes down to a fundamental split between two different kinds of digital money.
In their view, Bitcoin is not digital currency. You're not supposed to buy a latte with it. Instead, they call it digital capital. Think of it like digital real estate or digital gold. It's a long-term store of value, something you park your wealth in for decades. So it's not competing with the dollar in your pocket. It's competing with the S&P 500, with real estate, with gold.
And this chart just lays it out so clearly. You've got two completely different lanes here. In one lane, you have Bitcoin, the digital capital, going up against assets like gold and property. Its job is to preserve wealth. In the other lane, you have things like stablecoins, the digital currency. Their job is payments, moving money fast. They're competing with Visa and MasterCard. Totally different mission.
So, okay, once you accept that philosophy, that Bitcoin is digital capital, it leads to their next really ambitious move. They want to build a bridge, a way to bring this digital capital into the regular everyday banking system that we all use.
And they've got a name for it: Stretch. The whole idea is to create a product that's backed by Bitcoin, but from a customer's point of view, it just feels like a super high-yield treasury bill or a money market fund. Basically, it's a way for your local bank to package up Bitcoin into something that looks and feels familiar.
So you're probably asking, how would that even work?
Well, it's a multi-step process. First, a bank would take this stretch product and add a big cash cushion to it, kind of a shock absorber for the price swings. Then that cash is used to handle customer withdrawals, which is key. It means they don't have to sell Bitcoin when the price is low. Next, the bank would take the monthly payouts from the product and slice them up into daily dividends for customers, so it feels just like interest. And finally, the bank puts their own brand on it, gets it approved by regulators, and offers it to you.
So at the end of the day, what's the big takeaway here? The end goal is pretty wild. Imagine walking into your bank and they're offering a money market product that pays out 8%. And it's all built on a foundation of Bitcoin. I mean, we're talking about a plan that could completely shake up what we expect from consumer banking.
So, that's the playbook. And it leaves us with one massive question, right? Is what we're watching the very first draft of a brand new financial system, or is it just one of the gutsiest, most high-stakes bets in corporate history, all riding on a famously unpredictable asset? Honestly, no one knows the answer to that yet.